Let's talk about some of these types of entities individually. The first being sole proprietorship, and we've kind of already hit on a couple of things, right? It's easy and cheap to create. You really don't have to do anything. Okay, yeah, you'll file a Schedule C for your tax return. That's just kind of a statement of profit and loss, and that's it. Okay, and you don't have to, in Montana anyhow, you have absolutely no obligation to file any declarations to the state or anything like that. Okay, you may want to register your name. That kind of protects your name if in fact you have one that's kind of unique that you want to protect. But that's a decision completely up to you. A lot of sole proprietorships might operate without a name. Okay? Greater continuity, meaning that it's just you, and so as long as you stay alive and run the business, it's going to keep going, right? And you don't go broke, I guess, would be the other thing about that. You don't have to worry about a partner dying or members dying or shareholders dying. Liability is a negative, I would say, for sole proprietorships, meaning that you're completely liable for anything that would happen within the business. Okay, you yourself individually, obviously, you're completely liable. So, again, if your rock hits a person and causes lots of harm, a rock from a lawnmower or something hits a person and causes harm, they can sue you personally. And if you don't have enough insurance, they take your house and your car and those types of things potentially. That's maybe getting a little extreme because of some of the protections that are built in for that, but they could take your fortune, say. A smaller company, generally less owed. That could be maybe. I would say generally for small sole proprietorships, one of the other things that's nice and easy about them is that they generally don't have to comply with as many regulations. A lot of regulations are for companies that have 15 or more employees. Okay, that's I got to back up because that's not to say a sole proprietorship could have 100,000 employees. There's no limit on the number of employees that a sole proprietorship could have. It's just that most of them are, either an individual or one or two or three people maybe working. Flexible tax planning, everything. All the profits and losses flow through to the owner, so the owner has to pay taxes or get the tax benefit of losses on their own personal tax return. And so you can do a lot of jiggering there with your tax planning, running some expenses through the business that are legitimate, but otherwise you might not be able to, right? Partnership, okay. In a lot of ways, same as a general partnership, and we got to distinguish between those. We'll talk about the other types a little bit later, but a general partnership is just a lot like a sole proprietorship, except it has more than one person, right? At least two, or business organizations. So you could form a partnership between a person and a corporation. I could go in and we could make it really complex, or two corporations can form a partnership, and I've actually seen that fairly often. Right, they have a common business interest, sure. And the profits or losses from a general partnership flow through to the people or the entities that make up that partnership. And this is different than when we get to a C corporation, okay, a subchapter C corporation, which we'll talk about. Again, creation's simple. I've been in a partnership with a fella for about 20 years now, and we've never done anything. Okay, we don't have a name. We don't have meetings. Every now and then we'll have a beer just because we're out, and we usually don't even talk about business when we do that, and on. Okay, and that's perfectly fine. Now, if something happens to one of us, technically the partnership's dissolved. That wasn't hardly ever really created to begin with, and then he would become partners with my wife if it was something happening to me, or vice versa, right? Each partner has an equal voice, generally speaking. Continuity. So it's dissolved when ownership changes. So if something happened to one of us, technically the partnership would dissolve. Technically, you'd probably just create immediately a new partnership with, one of the other spouses or somebody else, whoever the heir was for that other person. Liability, and this is important. So liability is not limited. And what's that mean? That means that you can be jointly and severally liable for actions of your partner. okay, as they pertain to the partnership. You know, if your partner's off being, driving erratically and it has nothing to do with your partnership, you're not liable for that. But if your partner makes some decisions in regards to your partnership, that can have an adverse effect on you, and yes, you could be sued, okay, and held liable for those things. And taxation is according to the level of ownership. So again, taxation in this case flows through the tax consequences, either good or bad, flows through to the partners. Corporations, domestic versus foreign. And I don't think we're talking about foreign or overseas. It could be, but I think in this case we're talking about states. Okay, there are corporations that are incorporated here in Montana, and they do business here in Montana. Oftentimes, maybe exclusively here in Montana. But you could be incorporated someplace else. There's lots of companies that still do business here in Montana. Okay, and they would be considered a foreign corporation. Okay, in fact, the state that has the largest number of companies, like Fortune 500 companies, incorporated there is the state of Delaware. Yeah, interesting. Well, believe it or not, even way back when I went to college, which was a million years ago, a professor told me that Delaware had passed a law that said, no matter what other states do to make incorporation easy, we'll match their law. And so we will always be the best state, the easiest state in which to incorporate. And so lots of companies incorporate in Delaware for that reason. Okay. Creation, you have to file a charter. And to my knowledge, those charters are all at the states. Corporations are creatures of states. I mean, it can be expensive, and yeah, I mean, you got to fill out paperwork, you got to file it. If you're a corporation, you have to have a meeting once a year. You have to elect officers. You have to provide that information to the state. Okay, there's a lot of requirements on an ongoing basis for corporations that can make it somewhat expensive. Continuity, though. Okay, if you've set up a corporation, you have shares. If you die, the shares simply pass on to your heirs, and the corporation itself continues to exist. Corporations that we're familiar with, like GE or maybe General Motors or whatnot, some of those have been around for over 100 years. Okay, and obviously the people that started those corporations are long since gone. Publicly versus closely held, we talked about already. Liability is limited, and that's one of the main reasons people set up corporations, okay, or other entities where they limit liability. And what's that mean? That means that it's limited to your investment. Okay, so right now, if you were foolish enough, for example, to purchase stock in Sears Holding, which also owns Kmart, okay, when it goes upside down, you very well might lose your investment. Okay, that's the limit to your personal liability. As a corporate, as just a shareholder, they can't sue you for any other losses that Sears/Kmart may have incurred. They can only, your only loss is going to be the money that you invested in the company. They talk about piercing the corporate veil and alter ego theory, and in these cases, we're generally talking about smaller corporations that are closely held. Okay, and basically they're saying if the corporation and the person are technically and they act as one and the same, we might be able to get around this limited liability. Boy, I know in practice in the banking, there's a few times we had those discussions, and our attorney wasn't real optimistic about being able to pierce corporate veils. So it can be a difficult task, even if you wanted to, even if you thought there was, the corporation and the person were one and the same. Gets into liability questions, probably a little more complicated there than what we need. So corporations have shareholders. Again, you can buy stock in Microsoft or Disney or whatever it may be, and you'll get, if you own in a publicly traded company or even in a smaller one, you're going to get a notice of an annual meeting, and you're going to get the opportunity to vote on the boards of directors. Okay, and that's your right. You get to do that. You get to go to the annual meeting. They have to invite you. Okay, and you can go. And you can also make proposals and do some other things like that. Okay, the board of directors then hires officers of the company, and they run the day-to-day things along with the employees. So corporate taxation, and you're hearing a lot about this right now because there's a lot of there's proposals and a lot of news about changing our corporate taxation rate, changing the corporate rate. Okay, one of the reasons corporations, C corporations, and I have to be very specific and say that C corporations are said to be double taxed. And what do I mean by that? Well, what I mean by that is if Microsoft makes money, okay, they're going to pay a tax. And at this right now, as we speak, it's 35% is the federal tax. They may pay state taxes, although in Washington I don't think they do. But in other states they might. So they pay a federal tax rate of that, and then if they pay a dividend, the dividend's paid after the taxes. Okay, so in other words, they don't get to deduct dividend payments, and then the person, the shareholder, also has to pay taxes on that dividend. And so the profits of corporations, anyhow, are said to be double taxed. Okay, that's very expensive. That's not necessarily dissimilar from other countries, but what is dissimilar and what they're arguing about a little bit is that our corporate taxes are amongst the highest in the world, and they weren't always that way. You know, other nations in the past couple of decades have been pretty aggressive in lowering corporate tax rates in an effort to attract corporate headquarters, and to some extent have been successful. If you looked up inversions, inversions of corporations or whatever on Google or Bing, you'd probably find lots of examples of companies too that used to be headquartered in the U.S. and have moved their headquarters. One recent one was Burger King, actually. So, and that's just the double taxation that we talked about here, right? Okay, so avoiding it, how can you do that? Well, in a closely held one, you can just make sure that you pay out all of the income, right? So the corporation then shows a net, doesn't show a net gain or a net loss, and thus doesn't have to pay taxes. Okay, by that you pay salaries to your officers or their expenses, the ones that are attributable to the business and whatnot. Okay. You do those types of things to limit. Again, there are some reasons to set up small C corporations to do that. You see a lot of farms and ranches do that, and there's some specific reasons for that. We could spend a semester talking about that. Capital structure, equity versus debt. This for many of you is the first class you've had from me, but if you take finance from me and senior seminar and maybe some others, entrepreneurship, you'll hear me often say that debt is always cheaper than equity. Doesn't seem that way because debt you have to pay interest on and whatnot, but believe me, as we get in finance and get into some more details, debt is always cheaper than equity. Okay. Another way that you could avoid the double taxation is just to accumulate earnings. In other words, don't pay out a dividend. But at some point in time, you'll have to pay the piper. If you sell the corporation or whatever, there's going to be capital gains tax and some other taxes that would occur on that. So, and file as a subchapter S. Okay, so you don't have to be a subchapter C corporation. A subchapter S corporation really has all the benefits of a subchapter C corporation, but does not incur the double taxation, meaning that all the profits and losses flow through to the corporate shareholders. Okay. The problem with that, why wouldn't everybody pick that then? Because there's an obvious tax advantage to that, is that public corporations, if you have more than, I believe it's 150 shareholders, but don't hold me to that number, but a small number, relatively small number, if you have more than that in terms of shareholders, then you cannot be a subchapter S. So it's limited to smaller corporations, at least in terms of the number of shareholders, wouldn't necessarily be small by revenue or those types of things. So types of partnerships. We talked about a general partnership and how the assets are owned and the liability shared equally and whatnot, but you can also have limited partnerships. And with a limited partnership, you might have one general partner that is liable for all the debts and all the liabilities of the partnership, but you might have limited investors, okay, limited partners. I'm sorry, they'd be called limited partners, and they're considered a passive investor. And one important characteristic is that they don't get to have a lot of say in the day-to-day operations then of that partnership. The general partner is responsible for that because it's the general partner that also has that extended liability. Other hybrids we talked about as corporations. It truly is as simple as, if you're a small corporation, there's a checkbox on the on your tax return that you can say, I want to be taxed as a sub S corporation, and then all the profits and losses just flow through to the individual or individuals that own it. A limited liability organization, LLCs. And that's limited liability company. And these are, in the last 2 decades anyhow, they've become really, really popular. I would say probably one of the more popular entities for small businesses today. They're a non-taxable entity, meaning that, again, the profits and losses flow through to the members. That's what they're called in an LLC. They're called members, okay? And thus you don't have the double taxation. Okay. And your liability is still limited. So oftentimes what I've heard people say is that LLCs really combine the best features of a corporation and like a sole proprietorship, because you get the limited liability, you do those things. The other thing is the reporting requirements, and you don't have meeting requirements once a year like you have with a corporation, even an S corporation. So you don't have a lot of those requirements that you have with those with the corporate types of entities. Shareholders or members, referred to often as a partnership hybrid. Each partner in a partnership is jointly and severally liable for claims against the partnership. True or false? Absolutely true, right? So some trends, Dodd-Frank, and Consumer Protection Act, say on pay. They're trying to get maybe shareholders more involved in the payment of their officers and whatnot. It's kind of a republic format. You elect a board of directors, and they determine, officers' compensation and whatnot. But they're trying to get more of that done by shareholders, and also more oversight by the directors themselves. Active or activist shareholders are becoming a big deal. They're not necessarily boards of directors, but they show up and they do make proposals. Okay, and sometimes they do request to be on the board of directors. Okay. Now, use of deferred prosecution agreements, which basically you get one person to squeal on the others, when there's some types of a corporate governance types of an issue. So the law enforcement would come in and make a deal with somebody, right, that would then maybe get a reduced sentence or whatever to testify against others perhaps in the corporation. So that's it for entities, business organizations.